Welcome to StokTok's deep dive into Carvana. Carvana is an online platform for buying and selling used vehicles, operating without traditional brick-and-mortar dealerships. At the time of recording, the stock trades at $387.53, sitting in the upper half of its 52-week range of $194 to $486.89. The 50-day moving average stands at $331.56, now trading above the 200-day moving average of $365.45, a technically constructive setup. The RSI, or Relative Strength Index, reads 67.2, approaching but not yet at overbought territory. Let's work through the fundamentals scene by scene, starting with a quick business overview. Carvana's core revenue engine is its peer-to-peer style e-commerce marketplace for used cars. The company acquires vehicles, reconditions them through its proprietary infrastructure, and sells them directly to consumers online, capturing margin across the transaction, financing, and ancillary products. Its moat, in our view, rests on brand recognition, a vertically integrated logistics network, and the scale advantages of its inspection and reconditioning centers. The StokTok score sits at 47 out of 100, a caution signal. Valuation scores 13 out of 20, financial health 14 out of 20, profitability just 3 out of 20, growth 9 out of 20, and smart money 8 out of 20. Now, valuation. The question every investor has to answer: are you paying the right price? Carvana's trailing price-to-earnings ratio, the stock price divided by the last 12 months of earnings, sits at 48.2 times. The forward price-to-earnings multiple, based on next year's consensus estimates, actually expands to 55.5 times, meaning the market is pricing in significant near-term earnings deceleration rather than acceleration. That warrants attention. The PEG ratio, which adjusts the price-to-earnings multiple for the expected growth rate, comes in at 0, which in this context reflects data limitations rather than a genuine free lunch. The EV to EBITDA multiple, enterprise value divided by earnings before interest, taxes, depreciation, and amortization, is deeply negative at 502.44 times, a direct consequence of the company's current EBITDA profile, and a figure that makes traditional valuation frameworks difficult to apply with confidence. The price-to-sales ratio stands at 2.74 times. GuruFocus values the company at $238.49 per share at the time of recording, against a market price of $387.53, implying a negative margin of safety of 62.49%, meaning the stock trades at a substantial premium to this intrinsic value estimate. Wall Street analysts at the time of recording have a consensus mean target of 423, drawn from 22 analysts, with a high of 519 and a low of 300. The next earnings report is due April 29, 2026, with the street expecting earnings per share of approximately 1.54, ranging from 1.25 to 1.85, a near-term catalyst worth watching closely. In our view, peers in the consumer-facing automotive retail and e-commerce space have historically traded at more moderate earnings multiples, making Carvana's current pricing a high expectation setup. Market sentiment around Carvana, as of the creation of this video, leans neutral, with insufficient recent news flow to skew the picture in either direction. On balance, the valuation picture looks stretched to us based on the data available. Moving to financial strength, how solid is the foundation? The Piotroski F-score, a 9-point checklist that examines profitability signals, leverage trends, and operating efficiency, comes in at 6 out of 9 for Carvana. A score of 6 indicates a company in reasonably sound financial condition. It is not a distressed signal, though it leaves room for improvement. The Altman Z score, a model designed to estimate the probability of financial distress or bankruptcy, registers 5.59, firmly in the safe zone, where readings above 3 are generally considered low risk. That is a meaningful positive for a company that has navigated a significant debt load. On the debt side, the cash-to-debt ratio sits at 0.51, meaning the company holds roughly 51 cents of cash for every dollar of debt, not a position of excess liquidity, but not alarming in the context of the Z-score. Interest coverage, which measures how many times operating income covers interest expense, stands at 3.72 times acceptable, though a portfolio manager would want to see this ratio widen materially as profitability matures. The current ratio, which compares current assets to current liabilities, is a strong 4.31, indicating the company is well covered on near-term obligations. Debt to equity, however, reads 1.6 times, reflecting meaningful financial leverage. In our view, the balance sheet is functional and not immediately threatening, but the leverage profile demands continued earnings progress to sustain confidence. Next up, profitability. Is this business actually making money efficiently? Return on invested capital, the return the company generates on all the capital it has deployed across the business, is reported at 0%, a figure that immediately anchors the profitability discussion, and is, in our view, the single most important data point in this section. A business trading at a significant earnings multiple that is not yet generating measurable returns on invested capital is asking investors to pay for a future that has not yet arrived. The gross margin, revenue remaining after the direct cost of acquiring and reconditioning vehicles, stands at 20.63%. For a used car business operating at scale, that figure reflects the inherent compression of a product-centric, capital-intensive model. Operating margin, which layers in selling and administrative expenses, narrows to 9.26%. Net margin, the share of revenue that ultimately flows to shareholders as net income, comes in at 6.92%. Free cash flow margin, the portion of revenue that converts to actual cash the business can deploy or return, is 4.37%. The return on equity, which measures net income relative to shareholder equity, registers an eye-catching 68.88%, though this figure is substantially inflated by the company's leveraged capital structure rather than pure operational strength. Return on assets stands at 14.13%. The overall profitability profile, in our view, is emerging but thin, and we would want to see meaningful return on invested capital generation before placing full confidence in the earnings story. On to growth. Is this business expanding, and at what rate? Over the trailing 3 years, Carvana has delivered revenue growth of 14.3%, a respectable compound pace that reflects the company's recovery and operational scaling following a period of significant operational and financial restructuring. However, zoom out to the trailing 5-year window, and the picture changes materially. Revenue growth over that period is negative 5.2%. That divergence between the 3-year and 5-year figures is not cosmetic. It signals that the business contracted meaningfully in earlier years, and that the more recent acceleration is partly a recovery from a depressed base, rather than a clean organic growth story built on steady market share gains. Investors paying a premium multiple need to assess honestly whether the recent momentum is durable or cyclically assisted. Book value growth over the trailing 3-year period is reported at 0%, meaning the company has not been compounding the net asset value available to shareholders at a meaningful rate. A data point that, combined with the return on invested capital picture, suggests capital allocation efficiency remains a work in progress. Carvana pays no dividend, which is consistent with the company's reinvestment phase and its current leverage profile. We would not expect a return of capital to shareholders until the debt load has been addressed more decisively. In our view, the growth setup is more nuanced than a headline 3-year revenue figure suggests, and the 5-year perspective is the more intellectually honest lens through which to evaluate the trajectory. Now let's talk smart money. What institutional capital is actually doing with this name? 12 top-tier guru investors, as tracked by portfolio disclosure data, currently hold positions in Carvana. That is a meaningful concentration of sophisticated capital, but the direction of those positions tells a more cautious story than the headline count implies. Insider ownership sits at 1.38%, a low figure that means management has limited skin in the game relative to the market capitalization of the business. More pointedly, over the last 3 months of disclosed transactions, insiders registered 0 buys and 13 sells. That level of insider selling, with no offsetting purchases, is a signal a credit-minded analyst would not dismiss lightly. It does not prove a thesis, but it warrants acknowledgement. Turning to the broader 13F filing universe. These are the mandatory quarterly disclosures made by large institutional managers. Only 5.9% of filers are net buyers, well below the 50% threshold that would characterize a broadly bullish institutional posture. Among the notable Guru holders, Clifford Sasson of CAS Investment Partners holds Carvana as 83.25% of his total portfolio, though he has recently reduced his position by 5.72%. Robert Vinall of RV Capital similarly holds a large allocation at 29.81% of portfolio, with a substantial reduction of 31.86%. On the other side, Lee Ainsley of Maverick Capital has added aggressively, increasing his position by 112.31%. The smart money picture is, in our view, genuinely mixed. Concentrated long-term believers are trimming, while some fresh institutional capital is entering. That divergence makes the positioning signal difficult to read with confidence. And finally, the verdict. Let's bring it all together. On valuation, the data suggests a stock priced for perfection, a trailing price-to-earnings of 48 times, a negative margin of safety of over 60% relative to GuruFocus intrinsic value, and a forward multiple that expands rather than contracts, all point to a high expectation setup that leaves limited room for execution shortfalls. On financial strength, the picture is more constructive. An Altman Z score firmly in safe territory and a current ratio above 4 provide a reasonable foundation, though the leverage profile at 1.6 times debt to equity demands continued earnings progress. On profitability, this remains the most pressing concern in our view. Return on invested capital at 0%, and a free cash flow margin below 5% signal that the company is not yet generating compelling returns on the capital deployed across its operations. On growth, the 3-year revenue acceleration is real, but the 5-year negative growth figure provides important context that a complete analysis cannot ignore. On smart money, the combination of heavy insider selling, below-threshold institutional buying, and senior Guru investors reducing large positions is a posture we would characterize as cautious rather than constructive. Taken together, Carvana presents an operationally improving business at what the data suggests is a demanding price, warranting a measured and selective approach in our opinion. Everything in this video is our interpretation of publicly available data, not financial advice. Please consult a licensed financial advisor before making any investment decisions. That's the deep dive on Carvana. Like and subscribe so we can keep providing you with no-nonsense, data-driven analysis of stocks. We will keep updating our videos as soon as new data that affects the stock becomes available.